If you are a late investor who wants to start or improve your retirement investment portfolio, keep watching. When you start researching on how you should split your investments, you probably have heard the standard advice of a 60-40 split. 60% in stocks, 40% in bonds. And for many people, that's an okay path. It provides safety and comfort. But for me, I wanted something a little bit more aggressive. I needed something that would build my cash faster.
A 40-year plan is great, but some of us need to fill the seed bowl a lot faster. We needed a different pie.
Exactly, Henry. As a late investor, I didn't want slow growth. I want something that's going to build my cash flow quickly, aggressively. And a 3% yield is just not going to cut it. Because I started this journey at 46, I don't have 40 years to wait for a 60-40 split to build. So what I decided to do was actually have two separate portfolio accounts in my Robinhood platform. I have my Roth IRA where I put in money that's going to build my monthly cash flow aggressively. And then the other account, which is my taxable account, is where I have my growth and my other small dividend stocks that are building money, but it's easily accessible for me if I need it. Mine is called a 40-40-20 split, which is more of a modern twist on the 60-40 split. It completely ditches the bond slice and replaces it with high dividend yield stocks, or ETFs, to build that monthly cash flow fast. So today, Henry and I will be sharing with you this exact new modern split and how it can benefit all of us as late investors. Now, the modern 40-40-20 split is really interesting because it has a good amount of speed, but also safety. First 40% is where you're going to be putting in high yield dividend stocks or ETFs to build that monthly cash flow. The other 40% is for growth. And then the 20%, kind of like your miscellaneous, is just kind of like other stocks and ETFs that you might want to be invested in, or gold. Just kind of like a little bit more flexibility for yourself. I mean, yes, we're late investors, but why does it always have to be so boring? So my portfolio is not perfectly aligned to 40-40-20, and that's because many of my stocks and ETFs I had started before I even knew about this 40-40-20. And so now that I learned some more and stuff, I've kind of like been working towards that split, but the market changes, so it may never be exactly 40-40-20, and that's okay. It's just a framework. I mean, it's our income. We can do what we want with it. But the bottom line is that I am aware and strategically putting my money into places to help my income grow as quickly and safely as possible. Okay, let's go ahead and start with the cash flow engine. Now, for myself, right now, my piece of the pie on this portfolio is about 49%, and almost all of them are found in my Roth IRA, and that's done strategically because a lot of those are monthly paying ETFs and stocks, and so it's just building that money faster.
Because we already paid taxes on those seeds. Now the growth is 100% tax-free.
Exactly, Henry. So all the dividends that are getting reinvested, there's no taxes on them. Every penny is going right back into my position. So inside my Roth, my two biggest ones is SPYI at 67% and Maine, which is at 25%. And rounding out a little bit, I do have JEPQ and TOPW.
This is the high-speed seed incubator.
That's right, Henry. SPYI and JEPQ are covered call ETFs that turn market volatility into cash. Maine is a BDC, a business development company, and so they provide loans and stuff to medium-sized businesses and stuff like that. But because they are a BDC, they have to give out 90% of their taxable income. And so with them, especially with Maine, and I'm sure others, we have your monthly dividend, but then also every 3 months you have a special dividend, which is usually a little bit more. So right now with Maine, it's 25 cents for the regular dividend and 30 cents when it comes to the special dividend. So it's kind of like a little extra money. It's really nice to see. Now, because these are massive dividend yields,
the yields start around 4%. Think of it as a steady, reliable supply of sunflower seeds. You might see yields around 10% or higher, but the higher the yield, the wobblier the wheel.
They are taxed as the ordinary income. So if you do have it in your regular investment, you will be paying a higher tax rate on them. But because I have mine in my Roth IRA, I don't need to worry about that. Okay, now we're going to be talking about the second piece of the pie, the growth factor. And for that one, I have two different types of growth income stocks and ETFs that are in this. And it's about 37% of my portfolio, so close to that 40%. The core of this slice is SCHD, where it is about 50% of my taxable account. So if I need that money right away, there are no penalty fees, but I am paying taxes on them. Now, SCHD is known as dividend growth. And so yes, they are a lower yield, but they have very strong companies that they are invested in, and they have been consistently increasing their dividend every year. SCHD is not my only dividend growth stock or ETF. I do have T-Mobile, which for a long time was just strictly growth, no dividends, but they have become more of a dividend stock also, and that is about 11% of my portfolio. Now, what's nice with T-Mobile is it does have that growth factor, but also gives out dividends. So it's kind of like a twofold on that one. I'm working on my capital appreciation and my dividends.
So SHD and T-Mobile are planting seeds that grow into bigger seeds every year.
Exactly. But on top of SCHD and T-Mobile, I do have some that are purely growth. So I have Excelis, Elf, and Google. Now, Google does give out a very small dividend, but for the most part, these are just to grow the capital appreciation. And that just means I'm just waiting for the share price to go up. With a combination of SCHD, T-Mobile, Elf, Excelis, and Google, I have a powerful growth engine. Now, unlike my cash flow engine stocks and ETFs, SCHD is in my taxable account, but it is considered qualified dividends. So that means that I'm just going to be paying at a lower tax rate than the others that are sitting in my Roth IRA if they were in my taxable account. Now, you might be wondering, well, why do you have both? As we know, that's part of the 40-40-20. But the real reason is that I have 40% in my Roth IRA because I am really building that cash flow. And once I turn 59.5, then I can take out the money as I please to help me with my retirement. But I also wanted to have the growth and just being able to have immediate access to my funds if something arises that I just need to pay for and I don't have the funds. And that's why I have the regular investment portfolio. That way I can just take it out without any penalties. Okay, so that now leaves that 20% of what I call the miscellaneous. And for right now, I have about 14% that's there. And that includes like Kroger, JXI, VNQ, some cryptocurrency. I mean, to be honest, as an investor, you don't have to follow it exactly the way it is. And the reason why I feel that this is better than the bonds is because you are building that cash flow fast, especially if you keep it in your Roth IRA. So all the dividends that are being reinvested just continue to grow your snowball. Every investor is different. What works for me does not necessarily mean it works for everyone. So please do your own due diligence in finding out what works best for you as a late investor. And I am not a financial advisor. This is just what I'm doing. So this was just education for you. If you are new here, my name is Chelle. This is Henry.
Thank you for watching.
And we appreciate that you watched the video till the end. Definitely check out my Robinhood portfolio update that's here. That just kind of shows you how much I've made in dividends for this last month. All right, until next time, bye.